Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about NCINO Inc. Annual Report. NCINO Inc. offers a range of software solutions to financial institutions worldwide. The company's platform includes an onboarding solution that streamlines the customer onboarding process for credit and non-credit onboarding, commercial account opening, and enterprise-level onboarding. The NCINO platform also provides account opening solutions, including deposit account opening for consumers and small businesses. Additionally, it offers lending solutions, such as a commercial loan origination system that automates the loan lifecycle, consumer lending with automated credit decisioning, and small business loan origination for automation and machine learning. NCINO's platform also includes credit monitoring to manage credit risks and monitor performance, portfolio analytics for customizable dashboards to track data, and integration and intelligence for connecting core banking systems, fintech applications, and third-party services via open APIs and a partner marketplace. NCINO Inc. maintains a market capitalization of $2 billion, broadly in line with the industry peer group. NCINO Inc. trades at a higher price-to-earnings ratio of 345 times and a higher price-to-book ratio of 1.86 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 35% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for NCINO can be categorized into several key areas. Firstly, subscription revenues play a significant role in driving revenue growth, with fees for providing customers access to solutions and routine customer support and maintenance contributing to this growth. Additionally, new revenue contracts, upsell of existing contracts, and contract renewals are crucial drivers of revenue growth. These factors enable NCINO to increase its revenue base and expand its customer relationships. Changes in business conditions or market conditions can also impact revenue growth or decline. For instance, fluctuations in the economy or changes in regulatory requirements may affect demand for NCINO solutions. Furthermore, metrics such as deferred revenue balance, remaining performance obligations, cost of subscription revenues, sales and marketing expenses, and research and development expenses provide valuable insights into revenue growth or decline. These metrics indicate that NCINO has experienced a decrease in costs associated with subscription revenues and sales and marketing expenses. Lastly, regional variations in revenue growth rates also play a significant role in understanding the primary drivers of revenue growth or decline for NCINO. The company's international operations have shown higher revenue growth rates compared to its United States operations, indicating that expansion into new markets is a key driver of revenue growth. The net income of a company underwent a significant transformation between 2024 and 2026. Initially, it decreased by 24% from -$43,526,000 in 2024 to -$33,049,000 in 2025. However, the following year saw a remarkable increase of 129%, resulting in a net income of $9,703,000 in 2026. The profit margins also experienced fluctuations during this period. They decreased from -9.1% in 2024 to -6.1% in 2025, indicating a slight improvement. But the most notable change occurred in 2026 when the profit margin increased to 1.6%. This significant turnaround suggests that the company's financial performance improved substantially. The reasons behind these changes are multifaceted and not explicitly stated. However, some possible explanations include the shift from seat-based pricing to value-based pricing, embedding intelligence across all solutions, and increasing revenue alignment with the NCINO platform's value. Additionally, reduced demand for non-AI solutions and failure to achieve widespread adoption of AI offerings may have contributed to the initial decline in net income and profit margins. The company's operating cash flow has been steadily increasing over the past 3 fiscal years. In the most recent year, ending January 31, 2026, the company generated a significant positive operating cash flow of $254.7 million. This is a notable improvement from the previous year, which saw an increase to $206.9 million in operating cash flow. The data suggests that the company's financial health has been improving, with a substantial jump in operating cash flow between 2025 and 2026. The fact that the company is generating positive operating cash flow indicates a strong ability to cover its expenses and invest in growth initiatives. This trend bodes well for the company's future prospects and suggests that it is on a solid financial footing. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, the debt level decreased from $250 million available to $213.5 million outstanding as of January 31, 2026. However, this decrease was short-lived, as the debt level increased by $47.5 million from $166 million on January 31, 2025, to $213.5 million on January 31, 2026. In terms of interest expenses, there has been a notable increase over the years. The company's interest expense increased by 112% in 2025 compared to 2024 and continued to rise, with an increase from $8,745 in 2025 to $15,977 in 2026. This significant increase is attributed to various factors, including the accretion of $1.8 million over 2 years, starting from January 31, 2025. The total interest expenses have also seen a substantial rise, with an increase of $8,694 in 2026 compared to 2025, and a further increase from $8,745 in 2025 to $15,977 in 2026. These changes indicate that the company's debt level and interest expenses have undergone significant fluctuations over the past few years. The performance of various segments and regions within the company has shown some notable trends over the past 3 years. In terms of regional performance, the United States remained a significant contributor to total revenue, increasing from 81% in 2024 to 78% in 2025, before stabilizing at the same level in 2026. The international segment also showed stability, hovering between 19–22% of total revenue throughout the period. On the other hand, the United Kingdom experienced a significant improvement, with revenue increasing from $41,894 million in 2024 to $72,755 million in 2026. In contrast, the other region saw a decline in revenue, dropping from $47,448 million in 2024 to $58,765 million in 2026. Looking at segment performance, sales and marketing showed an increase, rising from $94,440 million in 2024 to $104,592 million in 2026 However, research and development experienced a decrease, falling from $101,017 million in 2024 to $106,478 million in 2026. Management is optimistic about the company's outlook, citing several key strategies for driving growth. One major focus area is expanding into new markets, both domestically and internationally, with a particular emphasis on increasing presence in EMEA and APAC regions. This will be achieved through targeted investments in sales and marketing efforts. In addition to geographic expansion, management plans to strengthen the company's product offerings by investing in research and development (R&D) and implementing AI and machine learning capabilities. These initiatives are expected to enhance customer value and drive growth through increased adoption of existing products and services. Strategic acquisitions and partnerships will also play a key role in accelerating growth, with a focus on expanding professional service capabilities and improving gross margins. Management is confident that these efforts will yield significant results, including a 23% increase in total revenue from $540.7 million in 2025 to $594.8 million in 2026. Overall, the company's strategy is centered around leveraging its existing strengths while making targeted investments in new areas of growth. By executing on this plan, management believes that the company will continue to achieve strong financial performance and expand its market presence. The company's financial activities over the past year have been focused on share buybacks rather than dividend payments. In 2025, the company authorized a $100 million share buyback program and completed another stock repurchase program worth $25 million in March of that year. By the end of 2026, the total number of shares purchased had reached 4,964,054. This significant investment in buying back its own shares suggests that the company is prioritizing shareholder value through this means rather than distributing profits as dividends. That concludes the financial summary for NCINO Inc. Feel free to comment below, and I will be happy to answer them when possible.